So we believe there's $100 trillion total addressable market for a digital monetary network. It shakes your faith.
Yeah, remove the blinders
in the
to
system.
some degree.
A negative real yield, minus 25%. That's the cost of capital. I think the formative event for a lot of people that are coming into Bitcoin right now is March 2020. If you wanted to specifically say what it is, it's the K-shaped recovery, Scott. At the point that the economy shut down and Main Street went to, 75% of, or 60% of economic output, which is pretty obvious to anybody walking around. You could see that the economic output was compressed by 20, 30, 40%. At the point that happened, and then we saw a V-shaped recovery in Wall Street, it's like a set of financial assets had an immediate V-shaped recovery, and a set of actual operational assets had not a recovery. And I'm very sensitive to that because I live in both worlds. Personally, I'm an investor. I'm a big tech investor in my personal portfolio for a decade. And so I rode that wave, and I know what it's like to be an investor and think like an investor. My other day job is I run a company, and I have thousands of employees and thousands of customers. And we have to produce something. We have to make something, market the thing, sell the thing, service the thing in a competitive world. And so when you're on Main Street and you're thinking about selling and doing something, you have one set of requirements. And when you're on Wall Street, you have a different set. And so I think when I saw that Wall Street had an immediate recovery and Main Street did not, I think that that caused me to lose a bit of my, well, what would be the word? It's like it shakes your faith.
Yeah, remove the blinders to some degree. Yeah,
shakes your faith in the system. And the first thing that has to happen is, well, if all the stocks are immediately recovering, even though Disneyland is closed, right?
Yeah.
If even though the airlines are down 95%, but airline stocks are moving up, if that's happening, then you have to ask the question, why is that happening? And that leads you to start to focus upon the role of central banks in Wall Street and the EU and the Fed. And when that happens, you start to question things you were taught, right? I think the greatest pernicious misunderstanding we have in our economy right now is the fiction that inflation is CPI. And I mean, I think this is the mistake, that Keith, and Hedgeye makes. And I try to point out to him, he's got a quad 4, and the quad 4 is based upon inflation going down. And the problem with that is, well, CPI is not inflation. CPI is a fiction. And everybody in the world, or at least I would say 90% of Main Street, they talk about inflation like they understand it, and then they lament that there is none. NASDAQ's up 53%. Big tech, they're monopolies, they're extraordinary, they're staying ahead of the cost of capital. Treasuries down 7.7%. If you were holding long bonds like TLT, that's a disaster. Gold up 9%. It's also a disaster. It's not keeping up with the cost of capital. So why Bitcoin? Well, you can't hold conventional treasuries. You're looking at a negative real yield against the cost of capital of 15 to 25% a year, right? I mean, I'm not a consumer. I have to manage shareholder value. And if you want to maintain or grow shareholder value, you're going to have to grow your assets at a rate faster than the cost of capital. So your hurdle rate is 15%. Now, what are you going to do? And I think, if you look,
I mean, it is a different definition of cost of capital that you have than, say, like a traditional accountant would have, right?
I don't think so. I think that a lot of people think about inflation. I think CPI. The cost of capital has always been in a conventional environment, risk-free, 6, 7, 8%. If you talk to any institutional investor in the past decade and you said, my idea is I'm going to invest your money at 1% or 2% or 3% interest, they would ask for it back. In fact, there's not a single institutional investor that can keep limited partner capital by promising 1 or 2 or 3% returns. So all investors know the cost of capital, it's about 7 or 8. Look, if you look at the compound annual growth rate of the S&P over a decade, it's 11.4% for the past decade. If you look at NASDAQ, it's faster, it's 17%. Big tech is better than the S&P. If you look at the compound annual growth rate of Bitcoin for the decade, it's 198%. Okay, so why Bitcoin? I have to move my money. Look, either got 2 choices: decapitalize the company or invest the money into something which is going to keep up with the cost of capital or exceed the cost of capital. So let's talk about giving the money back. Well, Joe, the road to serfdom would be for you to surrender all your assets and take a job working exponentially harder for cash, growing exponentially weaker. No family on earth would do that. No investor is going to give all their capital back to the limited partners, right? No endowment's going to work. No university, no company can function by surrendering all their capital and then working harder exponentially for a currency growing weaker. My view is Bitcoin is the underlying base layer of an emerging digital monetary network. If I told you that one day there'd be $100 trillion market for timberland, you might want to buy timber. And if you knew there's $100 trillion market for any other asset, oil or diamonds or name it, you'd want to buy a bunch of it. So we believe there's $100 trillion total addressable market for a digital monetary network. First of all, it's the hardest money on earth. It's an institutional grade safe haven asset. It's gold without all the imperfections of gold on a digital monetary network that moves at the speed of light that you can program to do 1 million transactions a second. So Bitcoin is digital gold on a big tech monetary network. Why would you want it? You would want it for the same reason that you want to run electric power to your city, or you would want to run running water to your building, because civilization is based on clean energy, clean water, clean communications, clean money, right? It is an extraordinarily important thing. Now, with regard to companies, I think the real issue here is if every currency is correlated to the dollar, right? I mean, they're all trading against the dollar. So if the dollar is weakening, every other currency is weakening, and then every stock and bond and commercial piece of real estate that generates fiat or US dollar cash flows or any cash flows in a fiat currency, they're all correlated assets, and they're all correlated ultimately to the dollar. So if we create 15% more dollars every year for the next 10 years, then you've got to discount the cash flows of every other instrument by 15% a year. And it doesn't take a rocket scientist to figure out that 80 to 90% of the value in those instruments is going to be collapsing if the dollar collapses. So if you want to preserve shareholder value, you have to buy scarce assets. Now, I could look for baseball cards or Picassos or sports teams, but it's hard to buy $1 billion of liquid, scarce trophy assets. So Bitcoin is the most liquid, scarce, uncorrelated asset that you can buy if you're trying to do this in a treasury. Let's look at the big picture. I've been a public company officer for 22 years. When you could generate 5 to 6% short-term interest on treasuries, and you thought that the cost of capital was 7%, then you didn't have to consider anything other than a conventional treasury strategy. You're maybe taking a minus 2% yield per year. I think that when conventional treasury assets started yielding 2% and you had a cost of capital of 7%, which is the expansion of the money supply, it became a minus 5%. People, they grit their teeth and they got through it. That was for the past 4, 5, 6 years. Now in 2020, we've seen the cost of capital explode. It's 25% monetary supply expansion. The treasury strategies are now 0, 1, less than 1%. So you've got a negative real yield, minus 25%. That's the cost of capital. Okay, that's actually turning up the heat that's causing everyone to realize that conventional treasury strategies are broken. Now, what are you going to do? Look at the last 12 months, ROI. Bitcoin is up 461%. S&P is up 25%. If you invested all of your treasury assets in the SPDR, in the S&P index, you kept up with the cost of capital. Okay, well, it reminds me of just, it's the famous quote from propaganda field, which is, all of our focus groups have shown us that we can't tell people what to think, but they've proven that we can tell people what to think about. Okay, so if you really want to drive people off a cliff, then you can't convince them of something that they know to be untrue. But we have the entire world focused on inflation, and inflation equals CPI, and CPI is us tracking a market basket of consumer goods. And in both the US and the EU, that market basket does not include the highly volatile energy and food. Okay. Right. Okay. So first of all, it's like, well, how am I supposed to live my life without energy and food? Okay. Like if someone walked in and said, well, Scott, you know, we're going to give you a market basket of things, but there's going to be no energy and no food in the market basket. Exactly how many hours or days am I going to stay alive with that market basket? It's a pretty silly notion, right? Just on its surface to say, I'm going to track a market basket of consumer products with no energy and no food. But it gets said, you know, it's like the preferred inflation metric of the central bank of the EU or the US. It's like, why do they get to choose? Right. Why do they get to choose what their preferred metric is? Second of all, everybody nods, oh yeah, we cannot include energy and food because they're highly volatile. That sounds like a Jedi mind trick to me. These are not the droids you're looking for. You're not the one. Okay, tell me one person on the planet that doesn't want energy and food. Okay, but let's put that aside because it's a classic example of misdirection. Because the massive elephant in the room here is the market basket ought to include assets. It ought to include real estate. It ought to include education. It ought to include scarce art. It ought to include the number one asset that the market basket should include is retirement, an annuity, basically a bond, a risk-free annuity. That is what everybody on earth strives for. They call it social security. The ability to live my life and not starve to death and not run out of stuff. The problem with inflation is what ought to be in the basket is social security or an annuity. And if it was in the basket, the inflation rate would start to track the monetary expansion rate. And this is the epiphany, the shattering understanding, which is inflation is not CPI. CPI is not a proper metric. Inflation is a vector. I can reasonably calculate any inflation rate I want, and I can get to a number between -4% or -10%. I can find deflationary things that'll be -10% to +25% or +25% in the US. And of course, other countries, you get something different. You know, the war on COVID begats a war on currency. But in a world where there's obviously something else going on, what happens next is you're jarred out of your apathy or out of your, out of your comfort zone, and you start to search. And what do? I discover the Bitcoin community.